Guys, I want to record a video with the exact market situation and share with you my thoughts on the market, whether we are in a bear market or just a correction or a bull market. But there are some reasons for concern. And this is why I'm not fully invested at the moment. I'm still investing a little bit. As you guys know, I am a big fan of dollar cost averaging, investing a little bit every month, but I'm keeping more dry powder on the side. And the reason why is because there is a storm in the sky, okay? You know, the sky is getting gray. We have those heavy gray clouds coming in the sky. And we don't know if it is going to be a huge storm or just a little bit of rain, because sometimes the sky is very dark, but then it's just a little bit of rain, or it can be a huge flood. We don't know what we don't know, right? There are known unknowns and unknown unknowns. There are things that we don't know that we don't know, and no one can predict what's going to happen in the market. That's why I'm not selling, okay, but I'm not like super bullish either. So I'm going to break down exactly what's happening regarding the Trump tariffs, the Federal Reserve interest rates, quantitative easing, and DOGE, the Department of Government Efficiency, and why this 2025 could wipe out reckless investors. And for sure, you don't want to be part of those reckless investors. There is a lot of happening. There is a storm brewing in the market. Again, like I said, there are Trump tariffs, and I will show you in this video what are the implications. You have the Fed policies. Are they printing money or not? Are they increasing the Fed balance sheet or not? I'll explain everything. And then you have DOGE, which is cutting a lot of government jobs, which in the long term is good, but there is some short-term pain that the market will suffer. So we are creating this unprecedented market volatility. Markets has been very volatile. Let me show you here. So this is the S&P 500. S&P 500 is down like what, 10% since all-time high since February. If you look at NASDAQ, it's even worse. But one thing we know when we look at these markets, we know that now at least it's cheaper than it was a couple of months ago, right? So NASDAQ is now 15% down, 13 to 15% down when compared to all-time high. And what I know when I look at these charts is that things now are cheaper. And I like to buy when things are cheaper, right? And remember what Warren Buffett said, be greedy when everyone is fearful, be fearful when everyone is greedy, and be greedy when everyone is fearful. So now I'm not bearish, but I'm not super greedy either. I'm buying a little bit. I'm buying index ETFs. I'm buying leveraged ETFs, Triple Q and UPRO, which is 3x S&P 500. I'm buying a little bit of stocks. I'm buying a little bit of crypto, but I'm not going all in, and I'm keeping 20 to 30% of my wealth in cash, okay? And why do I keep so much money in cash, 20 to 30%? Because the economy is facing a triple threat of tariffs, interest rates, uncertainty, and the government restructuring. And this combination is brewing that storm in the sky that might pass by and there's nothing about it. But the thing is that Trump is about to impose these universal tariffs, 10 to 20%, even up to 60% in Chinese goods. And these tariffs could increase inflation and force the Fed to respond with higher rates. As you probably know by now, one of the main goals of the Federal Reserve is to keep inflation low while optimizing the unemployment rate, or while keeping the unemployment rate at a very low level. So at the moment, unemployment rate is still low, but inflation starts to go up. And one of the reasons why inflation is going up is precisely because of the tariffs. Because if the US, when imports goods from other countries, from Mexico, from Canada, from Europe, from China, if we need to pay more, then the price of these goods will be higher and will increase inflation. And if it increases inflation, the Federal Reserve cannot decrease interest rates. The price of money is higher, and it slows down the economy, right? So what Jerome Powell said in the last FOMC meeting was that inflation has started to move up now, we think partially in response to tariffs. So the Fed might be forced to maintain higher interest rates in order to fight this inflation that is being created by the tariffs. And this will indeed create more uncertainty in the market. It will create more short-term pain. So what we see in the dot plot chart is that by the end of 2025, most likely the interest rates will be around 3.5%, okay? And this shows that there will be less rate cuts than it was previously thought. So the markets were expecting to have more liquidity being released by the Federal Reserve, more cheaper money. And because we have these tariffs might be pressuring inflation. The Fed needs to keep the inflation low by increasing or by not lowering, in this case, the interest rates. So this is a very challenging environment for growth assets. It's challenging for stocks, for tech stocks, for crypto, of course. And to better understand where the market is going, we need to keep looking at liquidity, the global liquidity. So you can go through TradingView and search for the indicator called Global Liquidity Index, which is kind of a better version than just looking at the M2 money supply. The M2 money supply is basically how much money is in circulation, but the Global Liquidity Index includes the central bank's balance sheets. But basically, what you need to know is that when these lines go up, stock markets will go up. And as you can see at the moment, this yellow line and the pink line is not going up that much. This makes some pressure in the stock market, right? So it's not looking very good in terms of liquidity in the market. Okay, and why is DOGE affecting the market so much? So the Department of Government Efficiency, basically, they aim to cut 20% of the federal spending. Elon Musk is one of the people leading these DOGE departments, and they want to streamline bureaucracy, eliminate redundant programs, eliminate waste, which is pretty good and positive, but it brings a lot of pain because the government at the moment in the US represents a large chunk of the economy, which is very inefficient, is not producing much, right? Because companies produce, not the government. But this government restructuring is causing some pain because government contractors and the sectors that are dependent on federal spending can face some disruption. So I see this pain that we are seeing in the market as something that is like more short-term pain. But again, it could take a few months, and that's why I'm not going all in the market. So we have a triple threat in the market at the moment, right? We have tariffs. Tariffs bring higher inflation, which brings reduced corporate margins, right? Companies make less profit. We have the Fed policy, the Federal Reserve keeping the higher interest rates, which increases borrowing costs for companies and individuals, which slows consumption, right? And at the same time, DOGE with the government spending cuts, which reduce fiscal stimulus in the economy. So these three things together are purging the markets from a lot of inefficiencies and a lot of mispricing. They're also creating good opportunities to invest, but that's why the market is slower. So as an investor, you need to understand what are the most vulnerable sectors, right? And the most vulnerable sectors at the moment are high debt, high import dependency, plus government contracts. So if you have companies that have high levels of debt, I usually stay away from those companies, right? High debt in their balance sheet. Companies that are very dependent on importing stuff from China or from Mexico, from Canada, and companies that are very dependent on government contracts. Those will also suffer. So these are mostly technology companies with global supply chains and high debt loads. I'll stay away from high debt companies, generally speaking. Consumer discretionary businesses that are reliant on imported goods, because let's face it, if we have the tariffs, right? Who is going to pay tariffs? It's not China. It's going to be Walmart, right? And they were going to pass those tariffs to the customer and going to also erode their margins, right? So when Trump says that it's China who is going to pay the tariffs, that's not really accurate. Who is going to pay is Walmart and basically Walmart customers and Walmart shareholders. That's who is going to pay the tariffs, okay? Of course, in the long term, tariffs might have a good impact because it brings more business in manufacturing inside the country. But in the short term, there will be disruption and pain because moving entire industries back to inside the country, inside the US, it's not like this. It doesn't. It takes many months to build factories, to build that infrastructure. Then again, government contractors will suffer. I'll be careful with those companies whose main customer is the government, and also growth stocks that are sensitive to interest rates increases. Because, for example, car industry, because people get car loans, and If it is hard to get a car loan or more expensive to get a car loan, car companies will be negatively impacted. So, what's the defensive positioning for you? Well, invest in value over growth stocks, invest in domestic producers with minimal import dependency. For example, now people are burning their Teslas and Tesla stock is declining so much. But the fact is that Tesla is the only car company in the US where the car is 100% manufactured within the US. Look also at companies with pricing power or software companies, and low debt business is also very important. So the conclusion is simple: preparation beats prediction. No one can really time the market. There is a reason why short-term traders 95% lose money. There is a reason why 80% of Wall Street fund managers who are paid millions of dollars, who had all the Ivy League, they have millions of dollars invested in infrastructure and the best computers. 80% of them still underperform the S&P 500. So don't try to predict the market. I'm not trying to predict the market because I'm still invested. I'm not trying to time the market buying and selling, I'm still invested. I'm not selling anything. I'm just slowing down a little bit my investments to make sure that I have dry powder in case the market dips even more. S&P 500 declined by 10%, Nasdaq also almost 15%, and now I keep buying because there is one thing I know, okay? Successful investors, you need to what? You need to buy low and sell high. And I know that now the prices of stocks and cryptos is lower than it was a few months ago. So now is actually a better time to buy than it was 1 or 2 or 3 months ago, okay? That's the only thing you know. If a stock was at $100 and now it's $80 and you still believe that that company is a good company, $80 is better than $100. So this is a no-brainer. That's why I keep buying good stocks, value stocks, stocks with good intrinsic value. I keep buying ETFs, index ETFs, S&P 500, Nasdaq, as well as leveraged ETFs. Yes, leveraged ETFs. I buy UPRO, Triple Q, QLD, SSO. If you don't know what these are, I will leave the link in the description of the video for a course, the very first course ever created about leveraged ETFs, which is one of the reasons why I managed to retire at the age of 39. But I digress. So I keep investing in those things. I'm also investing in crypto, although a little bit less because I have already a huge bag of crypto, and keep 20 to 30% of your net worth in cash, okay? And never forget, of course, to keep some emergency funds because we don't know if we are going to have World War III. Anyway, if you enjoyed this video, give it a like and subscribe so that you don't miss the next one, and I'll see you soon.